Thank you so much, Pablo. It's such a pleasure to be here with you all this morning. As Pablo mentioned, my name is Sohail Hassan, and I am a co-founder and managing partner at MarketSpace Capital, a private equity real estate investment firm located in Houston, Texas, that focuses on multifamily development and acquisitions. We currently have approximately 550 million of assets under management, with another 1.4 billion under development. And a major part of this success is due to our partnership with Finca Upper, whom we have been working with for over 2 years. This once was a business partnership that has now blossomed into a friendship, as we have now gotten to know the Finca Upper team as they have made countless trips to the city of Houston. Unfortunately, though, we have still not received a formal invitation to visit South America as of yet, although we hope to change this very soon and have an opportunity to meet some of you in person as well. But all kidding aside, together, we have made several real estate investments here in the United States, laser focused on the multifamily sector, even one, as Pablo mentioned, that we are in the process of exiting next month. So very exciting times indeed, and we hope that you too will have an opportunity to participate in future offerings. But today, of course, I'm here to talk to you about our latest project, the ground up development of 250 units in Dallas, Texas, called The Spot at Myra Park. If the agenda for our presentation today, if you can go back, Pablo, please, the agenda for the presentation is to give you a quick introduction of our firm, describe the current market conditions for multifamily real estate in Texas, and then proceed to get into the deal specifics, including showing conceptual images of the interior and exterior. And finally, we can get into the meat of the deal with the projected financial returns. Should you have any questions, kindly hold them until the end, and we will have a question and answer session where myself and our director of our acquisitions, Thomas Matthew, will be happy to answer your questions. Next slide, please. So as I mentioned, MarketSpace Capital specializes in acquiring and developing multifamily properties here in the United States. In addition to myself, we have two other managing partners of the firm. There's a gentleman named David Rodarte, who's been working in real estate his entire career. And the third managing partner and chairman is actually a practicing physician named Dr. Masaki Oishi, who is a practicing neurosurgeon here in Houston. In addition to still practicing medicine, he's also been investing in real estate since the early 1990s. He himself amassed a sizable portfolio. In 2010, Dr. Oishi and David partnered together, deploy capital into solid real estate investments, and they made their very first investment together in 2011 for a multifamily property here in the area of Houston. Since then, we've made a number of other investments into retail shopping centers, office buildings, and of course, family apartment complex. Our real competitive advantage lies in our data-driven approach to investments, for which we've created unique in-house proprietary models. To date, the firm has done a total of 21 investments, of which 7 of them, soon to be 8 and 9, have gone full cycle, meaning that we have successfully acquired and sold the properties. For those that we have exited, the firm has managed an investment level IRR of 28.5%. And now with the closing of the Morgan and Wilcox next, that number would be closer to 30%. Now, this is of course rather high for real estate investment, but we've of course been very blessed with investments here in the Texas market. But in order to manage proper expectations, we typically want all of our returns to pencil out in the high teens or in the low 20s for them to make sense for us investors. And while we still own retail and office assets, the firm made a strategic decision back in 2018 to divest out of the office assets and to focus only on multifamily. And of course, we were blessed to have made this decision early on because, as you may know, the retail and office assets have been suffering lately, right? But the multifamily asset class remains one of the most resilient. So it further reinforces our investment thesis. So in 2019, with the renewed focus on multifamily, we essentially create two distinct investment programs. The first is around our value add program, which continues to be our bread and butter until today. And the second, of course, is around our ground up development projects. So we kicked off our first development project, which was a garden style multifamily project here in Houston, which is expected for completion this November. The second project is the project that we are going to be talking about today, and that is, of course, the spot at Myra Park. Next slide, please. So as we talk about market conditions, it's important to note one thing, that Dallas has been one of the best performing real estate markets in the entire country, including last year at being the #1 real estate market. Furthermore, with the lack of construction and increase in home prices, this has created a pent-up demand specifically in this submarket, which, as you all may know, Dallas is home to some of the largest Fortune 500 companies, including American Airlines and Bank of America, as well as headquarters for a number of other, Fortune 500 and Fortune 100 companies. And finally, it's important to note that Dallas has really bounced back from the COVID pandemic in a strong way and is now on pace to achieve 2019 employment rates. Furthermore, and if you look at this slide, we can specifically look at the submarket of Farmers Branch, and you'll see that it has very favorable demographics in terms of income and education levels. The average household income is $124,000 in a 37.5 mile radius, within in a 3 mile radius, showing a very, very strong submarket. Next slide, please. Now, again, as we go into the details of the project, I want to take a moment to highlight some of the reasons why we chose this market, right? You can actually see here that the Dallas-Fort Worth area makes up the 4th largest metro in the country and actually the 6th largest economy in the United States. So Dallas continues to impress us. And unlike Houston, some of the benefits there is that they have a diversified economy, whereas Houston is very dependent upon oil and gas. So as oil and gas does well, the city of Houston is thriving. As it suffers, the city of Houston suffers. Whereas Dallas made an investment years ago in diversifying their economy and therefore have, again, attracted a variety of different Fortune 100 and 500 companies to headquarter there. Next slide, please. Here you can see our site. The site is strategically located right off of 635 and Webb's Chapel. For those of you that don't know, 635 is a major artery that goes through the entire city of Dallas with about 285,000 cars per day. Our site has significant visibility directly off of that freeway. In fact, we are perfectly situated. And if you can see the blue square here, and you can see the arrow where it says the LBG on and off ramp, you can see that our site is perfectly situated in between the on and off ramp, which means that you can easily exit from the freeway and turn into the site. You can exit out of the freeway and get right back, exit out of our site and get right back onto the freeway. The other thing you can note is that we are directly adjacent next door to the Dallas Medical Center, right? And as you can see on this slide here, you can really see the visibility to all of the major shopping and entertainment, as well as, the Dallas Galleria being only literally 10 minutes away, 4 exits away from this particular site. Next slide. So our project sits on approximately 6.1 acres, and we are constructing 250 units of a luxury multifamily development. We began due diligence on the site in 2019, in December of 2019. And after, it checking all of our boxes in terms of the due diligence, we ended up acquiring the site in May of 2020. So since May of 2020, we spent a year essentially finalizing the design getting the construction permits, and of course, getting the construction loan. We were able to kick off construction officially last September. So in September of 2021, we have kicked off construction, and we now have an expected completion date of between Q3 and Q4 of next year. And it's important to note that we actually acquired the land from the hospital next door, which is owned by a REIT, a real estate investment trust based out of California. And what is also interesting to note is that they too will be undergoing major renovations later this year. So we, of course, are investing a significant amount of money next door to them. And so this entire area right off the freeway in Farmers Branch, you can say, is kind of going through a renovation. Next slide, please. Excuse me. On this next slide, you'll be able to see, kind of the general design of the project. Here we call this what is known as a Texas donut, right? It has a pool and a courtyard in the middle, and it has a wrap feature. So it's basically a 5-story wrap, and it has a podium parking structure that allows the tenants to park on the same floor as their units. Next slide, please. Here you can see some of the layouts of the 1-bedroom and the 2 bedrooms. We have approximately a 50-50 split between the floor plans, with, of course, layouts that are, very amicable to kind of the idea of, being able to live comfortably. And also, in response to the COVID-19 pandemic, we made sure that we have the ability for people to work from home, and essentially created office spaces within these layouts for people to have the ability to do that. Next slide, please. Here you can see what the interior of the units will look like. All high-end finishes, granite countertops, stainless steel appliances. Again, this is a very luxury core asset. Next slide, please. Here's some renderings of what you can see. It's a wrap style. It will have kind of a red brick. This is what is required by the city Farmers Branch. And so we're very excited. It's very visible from the freeway. So, in terms of having, driving by, everyone's going to be able to see kind of towering 5-story wrap right off of the. Next slide, please. Okay, so I'd like to get into a kind of why we love this deal. Pablo, if you can go to the next slide. So first and foremost, as I mentioned, it's freeway frontage location, right? So when you are looking in terms of, as everyone says, the most important thing in real estate is location, location. Here, you consider this kind of being at the corner of Main and Main, in that it is in a very busy city of Dallas, and again, right off of 35. Another important thing to note is that this was the last zoned multifamily tract in the city of Farmers Branch, which means that there's not going to be a new competing product that's going to come in. It's only going to be renovations of older product, right? And the last multifamily product that was built in this Farmers Branch area was in 2014. Secondly, as we look into the data, we see that there's significant demand for these luxury multifamily in the Dallas area. The demand continues to outsupply that's in the market. So, we obviously feel secure in that the market dynamics are very. Finally, it's kind of being risked to a certain extent, right? We've already kicked off construction last September, meaning we've gotten our financing loan, we've started the process, we've selected our contractor. So the project has been de-risked to a certain point. Now, oftentimes in these projects, we will put money from our own pockets to essentially close the construction loan and kick off construction, right? Because we're not going to let the timeline essentially be delayed. So we will kick off construction and continue raising equity. And that's essentially what we're doing in this case, right? Where by the end of June, this will completely have been fully subscribed. And those investors, are going to be able to take advantage of an abbreviated construction timeline because the project is scheduled to be completed in Q3 or Q4 of next year. And finally, Dallas-Fort Worth continues to be the strongest submarket in the entire United States in terms of the numbers, right? And so even if you're looking at the sales of properties last year, it again is the #1 market. So, the fact that we were in not only in the state of Texas, but within the state of Texas, one of the best performing markets within the state is obviously a very big deal for this project. Next slide, please. So now we're going to kind of go through the financial summary for the project. And Pablo, you can see here, basically, again, 250 units. We're building this at a $65 million total development cost, which comes out to right under $260,000 per door. The appraisal that came in provided a projected stabilized value of $75.6 million or $302,000 per door. So there you can see kind of the value that we're taking advantage of. Again, it's costing us $260,000 to build. Very conservatively, the projected stabilized value showed that it would be at $302,000. So that value of that approximately $42,400 per unit is what we are capturing in this project. Now, again, with these types of construction projects, we always show a targeted hold period of around 5 years, which allows us, around 2 years for construction, another 6 to 9 months for stabilization, at which point we would immediately refinance the property. Upon refinancing, that's when we would start doing distributions to investors. And then around year 5, we would look to exit the property. Again, the timeline for this is, significantly abbreviated because the project is already under construction. In fact, we have just finished all of the site work for the project. And now we are starting on the parking garage. So as of 2 weeks ago, the parking garage, the piers for the parking garage are being drilled in. And, if any of you are in the city of Dallas, we invite you to come visit. Obviously, it is a live construction site, but nevertheless, we would love to have you out. And I know, the FINSA team has already been out to see it, but it is something remarkable to see happening. So we definitely encourage you to visit. Next slide, please. So here again, you can see that, the total all-in project cost I mentioned is right under $65 million. We have already invested 5% of this total equity into the deal. That's already obviously has been working into it. We offered our investors a 9% preferred return. So, on our value add deals, we typically offer 8%, but this being a construction project and there not being any cash flow for distributions, we typically offer our investors an additional incentive by upping the preferred return to 9%. You can see very conservatively here, and in our underwriting, we like to kind of under promise and over deliver. So we are very conservative in everything that we have taken into consideration, from a per square foot cost to even an exit value, which I'll show you, which you'll see here. Again, you can see that the net sales proceeds at a 5 cap is $83 million. But our data shows us that products in the Dallas market, these stabilized multifamily assets, are trading around 3 and a 3.5 cap. So clearly we're being very conservative by presenting a 5 cap here. But even at a 5 cap, we're showing an $83 million exit, which shows a very healthy return for our investors, or approximately, again, a very conservative, investor level IRR of 22.5%, and then a 2.73 equity multiple to our investors. All of our projects are structured in such a way that the investors are entitled to 100% of the cash flow until they have returned all of their invested capital, as well as any of the accrued preferred return. At that point, it goes to a 70-30 split, where 30% of the proceeds now start coming to us, the sponsors. So note that we are incentivized to get you your funds back as soon as possible so that we ourselves can start making money on the project. Next slide, please. As I was talking about earlier, in terms of the cash flow here, you can see that the first 2 years, it's all about kind of building up the cash flow and taking care of debt service, building up our reserves. But right after refinancing in year 3, that's where we essentially unlock all of the capital and proceeds for the investors, and that's when you would start seeing cash flows around that year 5. Again, this is just showing on the cash flow summary, but right around that year 5, we would seek to potentially exit the investment. Next slide, please. So just kind of giving you guys a timeline here, from our end, the minimum investment for the project is $50,000. We're projecting a 22.5% IRR. Once again, it has a 9% preferred return. And we're targeting a 5-year hold for this particular project. All of our distributions are done on a quarterly basis. So meaning that we take our reporting very seriously. We have third-party property managers that will actually manage the day-to-day operations, but we will manage the asset management in-house. And we have outside CPAs and that essentially provide the financials for us on a quarterly basis that we compile and we provide to our investors on a quarterly basis. Given that this is a construction project, we also have invited the PHINSA upper team to participate in weekly construction meetings, to be involved in kind of the process moving forward. So once again, thank you so much for taking